The FS month and the FS annual sheet share a lot of the same characteristics, essentially the same lines in the model. One is simply the annualized version of the other. So let me walk you through FS month first. So I was saying there are three main components to the FS month sheet, which are the income statement, the balance sheet, and the cash flow. So let me give you an overview of how those work. So the income statement essentially collects data from revenue and from cost of goods sold and from SG&A to give you the summary of the income or the performance, month-to-month performance of the company. None of these lines are input, so they're all being sourced either from the revenue sheet or the cost sheet or the SG&A sheet, with a couple of exceptions coming from the capital expenditures sheet, and of course, taxes. My recommendation is that you never input or replace values here, but that you always go back to the original sheet where that value came from and add it there, so that everything, including value-added taxes and everything else, is connected correctly, including your growth rates and a few other things. The dashboard even is connected directly to the revenue sheet. So again, you don't want to use the FS month sheet to generate inputs. Notice how all the numbers are black. You want to make sure that you go to the source and you input that value where it belongs. Now, the balance sheet section does have a few inputs, especially of values or lines that are rarely used in startups, but that we wanted to keep in the balance sheet anyway in case your specific company requires them. Some of them, like inventory or accounts receivable or prepaid expenses, you can manually adjust and they will balance out correctly in the balance sheet. A bit of an accounting lesson, but assets are things that the company owns that they can very easily or very neatly convert into cash. Long-term assets are assets that the company has, but that can't be converted into assets or into cash very directly. For example, equipment, computers and stuff like that, it's considered a long-term or fixed asset because you can't really access the money from those devices immediately. And we have room for other assets which are used by different companies in many different ways. Liabilities operates quite similarly, where you have current liabilities, which is stuff that normally needs to be paid up in the next year or so, in the next 12 months. And long-term liabilities like other debt that doesn't immediately affect the company. And last but not least, owner's equity is an estimation of the capital that's been invested in the business and how much of the retained earnings actually correspond to the shareholders and to the owners. And finally, cash flow is divided into operating activities, which is just a summary of the net income coming from the income statement, the depreciation, and the overall change in capital. You have investing activities, which are your purchases of capital expenditures. This is all connected automatically, so you don't really need to input any values here. They will be linked correctly. I'm going to show you a more complete financial model in a sec so that you can see how all this gets populated. And last but not least, financing activities, which is probably the most used input on the FS month sheet, around equity funding and around loan funding. So giving you the capacity to estimate new capital injections into your company, which we'll go to in a sec. So let me show you, this is a more complete version of this model that actually has a little bit of revenue coming in, a little bit of cost. So this is essentially a business that started existing in January 2023, operated for a few months without any revenue, and then starting November 2023, it started generating revenue because it launched a product. Now, as you can see, the model is automatically estimating EBITDA as a negative value, net income as a negative value, until eventually the company starts turning a profit and net income becomes positive. Depreciation and amortization is happening because the company has purchased some equipment. We can see that in the capital expenditures sheet. So the company has purchased computers for every new employee. And so we have that as a tangible asset, the computers, that are being depreciated automatically. So the way that affects the model is we have that depreciation, that monthly depreciation as an expense, but the company also has this asset, this long-term fixed asset corresponding to the equipment. Every month, the model takes care of estimating, the cash at the start of the period, the new cash after that, the retained earnings, and in the very end, the ending cash balance for the company. So if you were to be running projections for this company and you wanted to estimate, for example, how much capital you would need to raise in order to see this business through, essentially what you need to cover is this value, right? The amount of missing cash balance in the company for the company to operate. Now, in reality, it's very hard. In this case, this is a company that's going to operate at a loss based on its projections. It's going to operate at a loss for a few years. Maybe 4 years. I'm sorry, but 2 years? Yeah. So the company may not be able to raise all that cash right away. It may need to do that in tranches, kind of like rounds of funding. Okay, so let's add some capital injection estimations to see if we can get this company to profitability. We see that by here in the annual statement, we see that the EBITDA for the first 2 years is negative, but after that, the outcome of the company seems quite positive. We just need to cover this cash dip. Another way to see it is here in the dashboard, where we have this cash dip as the company builds a product, builds an audience, and eventually the company becomes profitable and cash starts growing again. So we need to cover that cash dip, and that's essentially why companies raise money. So let's start by adding a little bit of equity of what we would call a pre-seed round. So let's maybe set that to $350,000 as a start, set this to a pre-seed round, and set this financing type to a convertible note. These values are being linked to the cap table. So as new funding rounds get added, the cap table lights up and starts giving you an estimation of how much dilution is happening in the company. But we'll get to the cap table later. Okay, so notice what's happening here, where this capital injection of $350,000 got us enough cash balance in the bank all the way up to here, to October. But that's not a great position to be in to raise money because the product hasn't really launched yet. So if you raise $350,000 here, essentially fund the building of this product, but not the launch. And that's a bad position to be in because normally, at least in tech startups and in the US, seed companies are raised when the company has gained a little bit of traction. Also, raising $350,000 for just 10 months of operation sounds a bit short. So probably we're gonna need a little bit more, maybe $550. So notice how now the cash is stretched all the way up to January. So that's a year. That's actually not enough. So let's maybe grow that even more. $750. So this gives the company a little bit of runway all the way up to March, and by this point the company has a little bit of revenue, so it's closer to getting into a capacity to raise a seed round. Now, obviously, I've been very arbitrarily just increasing the amount of money that the company raises, but a more elegant solution would be to just maybe assume smaller expenses, right? So if we have this, the CEO and operations and VP of sales roles, for example, we could very easily come back to the staff sheet, get rid of this role, or delay this hire until a year in, and that way the company won't need so much capital at the very beginning. Cutting salaries or cutting your assumptions for salaries is also another way to achieve this. Okay, so now that we've stretched the capital a little bit, we can go ahead and assume what happens next. Right? How do we scale after this? So this might be another funding round after this, right? Because we'll need a few $1 million now to get through that next stretch. So, one fair way to do it is to come here and add a new input of, say, a $2.5 million round. This would be a seed round, and this would probably be a priced round. Notice how this automatically changes. It converts the safe into equity. It takes into account for the convertible notes interest rate, if there was any, and overall gives us this new equity funding at the end of the period. And as you can see, now the company has covered all their cash dips, and now the company can just operate at a profit or without running out of money. We might not need the entire $2.5 million. Maybe that was a mistake on my side. Yep. So this gets us to a very, very close line of $50,000 in the bank. So maybe something like $2 million gives this company a little bit of a cushion in case they're not exactly correct about their projections. Again, we can monitor this in the dashboard where we can see here how cash dips, we have a new cash injection, cash dips, and then the company becomes profitable. So the revenue of the company and cash in the bank just starts growing after that. So all of this stuff, all of these inputs are all connected in the model, which is easier said than done. But as you can see, all these capital injections are being connected appropriately. For example, the convertible note here at $750,000 is considered a long-term liability because convertible notes are technically loans until they're converted into equity. So right here, notice how this goes from being a long-term liability for the company to actually being contributed capital or equity funding for the business. For that convertible note, notice that if there was an interest expense, that's also accounted correctly in the month where that is finally accrued or where the convertible notes finally convert. Different jurisdictions might treat this differently. Some convertible notes accrue interest on a monthly basis, but that is a bit of a custom functionality that you might need depending on the terms of your funding. The last thing I'll show you is how income taxes are affected here. So the way the model ideally works with taxes, and we'll get into more detail as we go through the taxes sheet, but the way ideally the model estimates taxes is by estimating the income taxes due on the profits of a given month. So even though they're only paid at the end of the year, the income taxes are excluded of your net income on a monthly basis. and they're carried over as an account payable for the current fiscal year. They're carried over until finally at the end of the fiscal year, that converts to becoming a past fiscal year income taxes payable that then get cashed out or paid out and reflected here in the cash flow and in the change of working capital. This is as technical as the model gets on the FS month sheet because there are a lot of lines here. But just bear in mind that income statement is where you're going to be putting most of your work. Net income for you as a founder is probably the part where you have to make sure that this number is positive. And most importantly, probably most important than everything, ensuring that your ending cash balance at the end of every month is positive and keeping an eye on it to understand how much runway you have left, how much you're spending, and so on. The dashboard is a bit of a useful tool to understand how many months you have left of profitability, left to reach profitability, and how much runway you have left. We're currently, we're currently using the current, so it's taking the data from March 2024. But you can use this drop down to kind of switch and see how much runway is left at any point in time. Last but not least, if your company has been operating for a while and you need assistance syncing this model and syncing this sheet to your actuals, to the actual performance of the company, our team can help. So you can find links across the model to book a call with our team and get a quote for us to assist you.